Hello, everybody. Welcome to Friday, another Talk Money with Tom show. We are coming live today from Silicon Valley. We are here to try to help you improve your retirement. We do that by answering your questions, so feel free to send them in now while we're live. We'll try to answer those. You can send them in during the week. While we're live, you can send an email at the address that's here on the screen, or do the chat if you'd like also. Send the email during the week if you'd like and whatnot. We always cover questions that come up in our strategy sessions with our clients also. We are big believers that, trying to educate our clientele and the public about retirement planning, asset management, tax planning is a really important component of trying to have a more successful retirement. So what we've done here with this channel is we have over 1,000 videos now on the channel. You can go look at those. You can also subscribe to the channel. You hit the little button to subscribe, and then you can hit the little bell button that's next to it if you'd like to get notified when we put new content on. And of course, we're always available for an appointment if you'd like. You can meet with Eason and I. There's a book an appointment button at the top of our website. The link to our website is here on the channel also. Schedules live. You can set up a 30-minute, time to meet with Eason and I on a video or a phone call and discuss your questions on a personal basis as far as that goes. So looking forward to being able to try to help you today as much as we possibly can. I do always like to start off the show with a summary of kind of what we saw happening this week in the market. Actually, this has been 3 weeks altogether since our last show. Had a couple weeks off here. And kind of interesting, actually not a lot has moved. A lot has happened. But if you look at the last 3 weeks there on the S&P 500, kind of in the same place. And actually one of the things that's quite interesting, I think we're right about where we were at the very beginning of last May. And so almost a year of sideways motion here altogether, with a really big range. I mean, it's about a 20% range from high to low. The stock market averages 11% a year, so that's a big range to kind of end up in the same spot. Lots of things have happened. But if we look at this in totality, we can see, starting at the top back there at the end of beginning of 2022, we had several big run-ups, all of which ended up lower than the previous run-up, connected somewhat so by that red line. And then finally this year we broke through that red line. We set up a new high. Then we came back down and challenged the low that we'd hit before, came through the red line a little bit, and then came back up. And so what's significant about right now is that really, in a technical sense, we should be kind of breaking up into another new high. And we're really struggling to do so. Having a good day today, but overall kind of a downward week as far as that goes. And really there's a couple things that I think are going to put a top or a hat or whatever you want to call it, resistance on this market running up a lot. The first of all, of course, and we'll talk about this more, but is the debt ceiling, argument. This week we had Janet Yellen coming out saying that, we're going to run out of money on June 1st. That's a lot earlier than was expected. We've been told before, maybe end of June to the end of the summer type of thing. So June 1st is, not very far away. So that kind of created some problems with the market. And of course, now we've had some continuation of issues with the banking arena. And of course, last week we really had the First Republic Bank is now going to be absorbed by JP Morgan Chase. And then this week it's PacWest, America, Bancorp, and First National, et cetera. And so, we've got this situation where I think the banking situation is important in the sense that originally we heard about several banks, and all of those have been resolved in one way or another. And the last one was First Republic. Okay, so maybe it's done, it's confined. We have Chairman Powell at the Federal Reserve coming out this Wednesday saying, hey, banking system is very sound, it looks good. And then right after that, we start hearing about these other banks, and they've had big drops in their prices. Today they're up a lot. Yeah, well, it's kind of crazy. So if you're trading in regional bank stocks, you're having a heck of a roller coaster ride. So I think PacWest was down like 40-some%, and then 30-some%, and now it's back up 80-some% today. Just kind of wild.
So way below. It's like a normal.
Oh yeah, and it should be. I mentioned this before, but PacWest reported earnings. I believe it was last week, and they were well received. Stock went up. Deposits were up for the month, and all these things. And then this week, it was reported in Bloomberg that they were pursuing a sale. Lots of reasons you might do a sale, but in this particular environment, anything is seen as possible negative, and that's what started the whole thing. And all of a sudden, we're looking at all these other banks at the same time. So it's a little hard to tell for sure what's happening, but one thing that is certain is that when a fear of a bank having problems come into play, all of a sudden you can have kind of a run on that bank. And in today's world, a run on the bank is digital. It happens very quickly. Literally within a matter of minutes, a bank can have so much deposits leave that they don't have the capital to do that. I mean, everybody kind of knows this, but you give the money to a bank and they put it somewhere else. It's usually not that liquid. It could be in a 30-year mortgage or, those types of things. And so trying to get that money back quickly to give back to depositors can be a challenge, right?
Yeah, it takes seconds. Like I can just go into my bank account, put in a new routing number, and the money's out.
Yeah, they actually have services for some of these big companies where, they guarantee they can get the money out in a couple of minutes and those types of things. So this is a new arena that's really going to be difficult to deal with on a regulatory basis, and it's kind of wild as far as that goes. And so anyway, you could have a fairly sound bank that all of a sudden has a lot of deposits leaving quickly due to a rumor or something that you're trying to do that's fairly legitimate. The overall banking system that is supposedly sound, according to Jay Powell, would definitely be the large banks. They seem to be doing pretty well. As a matter of fact, J.P. Morgan Chase just is going to be absorbing, First Republic Bank. It kind of shows you, who's out there. PNC was in the running for that, so we'll assume that they've got some decent,
yeah, it's because most of these major banks, they've gone to a size where usually with antitrust, they can't get any bigger with by acquiring firms. So this is kind of like a fire sale for them.
That's right. This is where they kind of bypass that antitrust to allow this to happen in this particular environment. Now, in the 2008 crisis, they did put into place some rules where the big banks have to have more money on hand than the regional banks. Mm-hmm. And so that's kind of creating a problem right now. And of course, the big banks are probably getting a lot of this money. We've seen several headlines for some of this money and where it's going. And one of the things that's very fascinating is that the bank itself it really is kind of revolving around how much money it has that's not insured, right? And so I know reading an article about Silicon Valley Bank, sorry, that they had 94% of their assets were uninsured, over $250,000 for that depositor. But sounds okay, except for the fact that the more likely to have a run on your bank when it starts to have problems. If you had, 5 million there versus, 50,000, you're going to maybe move that. So the more a bank has over and above the insured amount, the more risk it has of having a run on the bank. And so that's one of the things that's now being kind of looked at within all of these banks. So it's really a fascinating arena. So lots of other things are happening, though, and there's some really good things. I do think that the banking and the debt ceiling situation, and I'll add the Federal Reserve pausing on rates. Okay, those three things have to happen here for the market to really take off. And the banking situation is probably very unclear as to how that's going to be taken care of. I will say you got to be real careful of getting super cautious in these environments, because if the government steps in, they can backstop these banks and basically take care of this situation on Monday. It's hard to say what's going to happen. All of a sudden, the market's moving up really rapidly because of that. And so altogether, that's something to be aware of just as far as that goes. Now, our current signals for this week are for the stock market. We are at yellow on the fast signal, and we made some conservative moves yesterday on our IRA type assets. So yellow just means we're still in the market for the most part, just using things that have lower standard deviation, a little bit lower risk. So if the market does continue down, we'll go down less would be the idea. And if it goes up, we'll go up, sometimes go up less, but we're just pulling back a little bit of the risk of the portfolio. We're still green on the slow signal, which just means that our taxable accounts are still kind of out there, participating in the market. We try to, reduce transactions in those taxable accounts because they have to be put on the tax returns, and sometimes there's a gain in there, so we have to be careful. Now, our bond market signals are currently both green. And so, again, that's not unusual in an environment like this. The Federal Reserve has talked about the possibility, or at least Jay Powell hinted at the possibility of pausing rates at the next meeting, those type of things, and we'll talk about that. That's a situation the bond market likes in terms of the price moving up, and so we've seen some stability in that arena, which ironically could actually help the banks. The bond market recovering in price would help the banks at this point in time, just because that's one of the big problems that they've had here as far as that goes. So let's take a look at some of the other things that are happening here, which I think are interesting. So first of all, we have the non-farm payroll. So this is just how many employees are out there working right now. So today is the employment report day for last month. We had a lot more jobs added than expected. Although ironically, they went back and adjusted the last 2 months down quite a bit. Makes me wonder a little bit about what this number really is. We'll find out maybe in a few months. However, if you look at that, you can see the huge job loss, about 15 million jobs during the pandemic. But we are now above where we were in terms of the pandemic, which is a good sign. So the labor market is doing quite well. And this is the unemployment rate. Now, I'm actually showing you a really long-term, view that's going back to 1948. Today's unemployment report was reported at 3.4%. The last time we were at 3.4% was 1969, a long time ago. We weren't there that long. The time before that was, back in the late 50s. So this is a really, really low unemployment rate. Again, showing kind of the strength of the market. And this is kind of a weird good thing, is that the number of job openings has actually come down some, because what happened was that the number of job openings was so high compared to the number of people looking for work, we saw wages just kind of skyrocketing, which is a very heavy inflationary environment to be in. And we're starting to see some drop off. We're still at record levels, essentially, at 1.6 jobs open right now for each person that's looking for a job. But it was closer to 2. But as that comes down, that kind of takes some of the pressure off, and we start to see, hourly earnings are jumped a little bit this last month. But if you look at the trend here over the last year, it's at 4.4%, 4.5% increase. And again, if I have a job, I want to see that increasing as fast as possible. If I have investments, I want to see that being somewhat moderated, because this is what can drive inflation, which makes the Federal Reserve go crazy on raising rates, which causes bank problems, which will cause other problems, right? And so it's this cascade. So, but this is a good trend altogether. The wage rate is staying in a moderate range. It's not getting out of control, even though we have a lot of job openings and what have you too. And then the participation rate, which is very important. If you have a lot of job openings and nobody wants to come out to get them, you're going to have to spend a lot of money trying to compete for those few people that are trying to get them. And so the participation rate is the number of people that can work, how many of those are working. So it's at 62.6% right now. And the main thing there is trend, right? We're not back to where we were participation-wise before the pandemic started. You can see that. But we're continuously moving upward there, and we moved up somewhat today also.
Yeah,
so.
It seems a lot of people more as pandemic is essentially considered over now. They're coming back to the workforce. Childcare is a lot easier, and everything's going well.
Yeah, exactly. Kids are back at school. They might have burned through any money that they did save during that period of time. Things cost more. And there's a lot of job openings, right? So we're getting a lot of people back into the workforce. Still got a ways to go to get the full participation back up, but it is getting there. So these are all really good things. And this is what, during the conference for the Federal Reserve, they always announced, hey, we did a 1/4 point increase. Here's what we see. They took some wording and changed it to basically saying, instead of saying we anticipate future increases, is we're going to evaluate whether we should have future increases. I'm paraphrasing, but it is significant, and actually Jay Powell pointed to that part of the statement a few times. But he also said that he doesn't feel like we're going to have a recession. That's his outlook. He feels like, as he said, he's maybe in the minority there a little bit, but he thinks that what I'm showing you as positive here, this job market and the labor market, combined with the demand, the pent-up demand and people spending money, is going to offset the increases in rates, the banking problems that are going to cause banks to cut back on lending and those types of things. And that we have a chance of kind of coming down the middle, in kind of this soft landing arena. Anyway, we'll see how that plays out. I hope he's right, because that would be perfect, and the market would really like that, especially once they stop raising rates, once the banking situation gets under control, and once the debt ceiling's done, this market could pop, because there's just so many good things. Here's what they're looking at, all right? So I'm putting up the consumer price index. Here's core inflation, right? And so you can see that that's been a little sticky. This is the last 3 years, jumped way up. And this is one of the numbers that they're focused on. So CPI is a basket of goods, and that basket has had food and energy removed. They call that core, and that's what the Fed tends to look at more often. And they especially look at this next chart, which is PCE, Personal Consumption Expenditure Index, at 4.6%. Jay Powell talked about this during the conference. That needs to be at 2, right? That's what they're trying to get at 2. And you can see there's a slight motion downward here, but not enough. So it's still sticking up there. And this is why they did the quarter-point increase, right? One thing, though, if you look past that, and they talked about this also, the PPI index, this is the producer price index. So this is kind of wholesale prices. Now look at that. That's a much different looking chart. So this could be, and most likely is, a precursor to inflation for those 2 previous charts. So if we see faster decreases on the wholesale side, eventually that comes through as decreases on the consumer side. It just takes a while. There's some margins that are probably being made there, but then competitive pressures kick in and companies start to maybe not cut costs per se, maybe on some things, but not across the board, but just start to increase costs at a slower rate.
And then demand also, as prices keep going up, demand slowly stagnates away.
Yeah, exactly. And so that's good. Inflation is likely coming down, right? It's going in the right direction. Let's put it that way. We have the employment situation is really, really strong, right? Both those. We are now, I think 90% of the companies on the S&P 500 or 85% have reported so far for this particular quarter, and almost 80% of those companies have beaten expectations.
Is that kind of the baseline percentage usually?
It's higher than the average, higher than the 5-year average. Now, the amount of how much they beat, because it's about 7% higher than the expectations. That's a little bit lower, but the number of beats is higher. So what's happening is that Wall Street is kind of looking at all these situations and really ratcheting down expectations. As those expectations come down, that affects the stock market. And then as they report, they're beating those expectations, and they weren't supposed to be. I'm not kidding. I mean, if you look at what was reportedly going to happen in the fourth quarter, first quarter, that hasn't transpired. I mean, it really hasn't. And that's why the market is still hanging up there, in my opinion. So this last chart is just the Fed funds futures market. This is where the futures market is betting on where the Fed funds will be, right? And so right now the Fed funds is at 5 to 5.25, a little bit of a range that they use all the time. That was with the quarter-point increase. And if you look closely at this, it's saying by January of next year we're going to be at 4.3%, which is about a 0.75 to 1% drop from where we are now. And you can see, actually, prior we had a huge run-up. Big run-up. Now that was at the beginning of the year. If you recall, we had some really hot numbers come out from retail sales and from the job reports that were coming, and the market started anticipating, the Fed's going to have to fight this. Maybe we're going to go to 6% and what have you. And then Silicon Valley Bank went out of business, and all these other banks started to come through, and that's that big cliff that we're looking at, just right there. Now, what's happening is that the market is saying, hey, you're going to be lowering rates. And as of yesterday, when those other banks had problems, that lowering has now moved into high probability by July, by the July meeting. And actually a 25% chance that they would actually reduce rates by the June meeting.
Mm.
And again, this is anticipation of having more problems with the banks and those problems continuing to create other problems. Sometimes that's not true because the government steps in and backstops these and does different things. So we'll have to see how that plays out. But it would be kind of fascinating. They raise rates here in May and then they lower them again and starting in June. Now, one thing to keep in mind here, what the market is telling us right here with this is that there's an expectation for a recession. That's why they lower rates, right? And so a recession would bring down prices. Inflation should fall in a recessionary environment, theoretically. And we would have, lower rates while the Federal Reserve tries to support things like, a banking crisis from getting bigger or whatever it might be. And so that's what's really fascinating to me. Now, one thing to keep in mind is the stock market is operating on the next cycle. So once they start lowering rates in anticipation or in middle of a recession, the stock market often does quite well. Mm-hmm. I remember my grandmother asking me once, why is the stock market going up when unemployment's going up and, jobs are being lost and those types of things? It's because the market's looking at the next cycle, which would be an upward cycle, right? We've already had this big drop. We had a 28% drop from high to low, from last year, and in anticipation of this recession that we're still talking about today. Now, the problem is, in the question and answer session, they asked Chairman Powell, do you expect rates to be coming down? The market expects rates to be coming down this year. And he said no. He said no last time also, and the market responded negatively to that. And this is one of the fears, is that, the market sees things that maybe the Federal Reserve doesn't, and we're going to have to find out who's right here as far as that goes. Usually the market is more correct, and Jay Powell might be changing his mind on, lowering rates at some point in time. But again, his outlook is that we're not going to have a recession because the combined forces of good versus bad are evening out each other, which is true right now. But what the market is seeing is that bad could get worse here, especially with this banking problem, right? So that's what we're playing with right now. Very, very fascinating time frame. I think it's a good time to be yellow. Again, we don't respond to all this news and the debt ceiling issues and those types. We respond to looking at the market and evaluating what the market is doing and looking at the price movement of the market and responding to that, because there are things that we don't know about that are out there that are probably already somewhat factored into the price. And there are a lot of things that we're talking about that might turn out to be nothing, right? Mm-hmm. And so that's why you just kind of respond to that. So again, I do think it's not a bad time to have a little bit of a yellow light here, just because of what I'm seeing with the price. We didn't break into a new high. We kind of broke down when we got to the previous high, and that's important. Today's up, so maybe things improve. All right, so that's our summary. Again, a little bit longer than usual, but it's kind of been 3 weeks since we talked last. I think that it's really an important time frame. You can learn a lot by what's happening here and learn a lot about, how to manage money here also. So thank you for joining us for this summary, and we'll look forward to doing the next one next week too. All right, let's look at our first questions.
Should we be concerned with the banking industry? Why does it keep spreading?
Yeah, so this is a type of questions I've been getting a lot from the clients also, and I think it is significant that it's spreading. And I've said this for the last few weeks. Basically, it's these First Republic was what we were talking about. A couple of weeks ago, that was the big issue, and I said at least so far we're talking about the banks that we were talking about originally, and we weren't talking about other banks. This week, really as of Thursday and Wednesday, we're now talking about other banks, which is kind of I think a problem, and it's kind of moving through. And one of the problems is that, again, the money can move so quickly in and out of a bank that and I think a great example here is PacWest. So they a week ago they report earnings. They're pretty good. Their guidance seems okay. Deposits are up. Stock went up on that report. And then on Thursday, I guess it was after hours on Wednesday, Bloomberg reports that they're looking for a sale. And on Thursday, they drop, I think, 49% or something like that day. Again, this is the type of thing that's happening. Of course, then once that happens, people start doing their withdrawals, and they can go from a bank that's doing fine to one that's not in a matter of minutes.
Yeah, and fear spreads like wildfire. And essentially, a bank run is just to play on fear,
Right.
And the problem is fear spreads to everything. So if you don't feel comfortable with your current bank, you're above that 250,000, you're gonna pull your money out and make that 200.
Even if you're below the 250,000, I've seen within my clientele, people are concerned, they don't want to have to deal with it. And you're exactly right. One of the problems is there's lots of options.
Yeah.
I can move it to one of the big banks. I could go buy some treasuries directly, or, whatever it is. It's not like that money has to stay at First Republic or Bank PacWest or any of those places. So, yeah, that's an issue. What has helped so far is the government standing up and helping out, and really, because if it is purely fear, which it seems to be mostly at this point in time, then the government can assuage some of that fear by standing up and saying, hey, no, we're standing behind these banks. You don't need to worry about it. We're going to cover deposits. It's somewhat of a problem from a pure capitalistic system situation where, hey, really, we're only supposed to be covering 250,000.
Yeah.
But in today's world, right at the moment, there's a little bit of an expectation that everything's going to be covered. Is there enough money to do that? Because 2008, what happened, and I remember this very specifically, is we kind of just, hey, things are okay, and then a little bit of things were happening, and then this company's having trouble, that company. We got to Bear Stearns, bailed out Bear Stearns, it's sort of like, the dike is leaking and, you're putting your fingers in the dike. And we got to Lehman Brothers and decided not to fix that leak. Had another finger, could have done it. It was a $150 billion bailout. Decided not to, and whoosh, we ended up with a 30% stock market drop, and a bunch of people got unemployed, and all these things. And by my calculations, roughly $7 trillion was put out in stimulus packages and TARP and all those things to kind of get things going again. That was the beginning of the big stimulus, quantitative easing, all those types of things that we've now used in the pandemic here to kind of get us going also. And so overall, very fascinating situation that's happening within the banking system. So yeah, we'll see how this plays out. I think that the government learned its lesson from the Lehman situation and will continue to stand up and backstop here. We'll
I
see
think
how
there's
that
too
plays
much
out.
political capital be lost if you let the economy fail.
Yeah, there's still concerns whether they can do it all. I think they can. It is the regional banks and not the big ones, which is good. There's some concerns about, because this is, the bond market decrease was the big driver of this, one of the big drivers of this. Well, it decreased around the world, not just here. And so Credit Suisse in Switzerland, had to be bailed out because of this also. What other banks in other countries where the U.S. can't stand up and say, hey, we're going to backstop that bank? And does that cause problems coming across? So again, we have a yellow light on our signal right now, which I feel comfortable with in this environment because of that. It's good.
Can you give your thoughts on the current debt ceiling situation?
The debt ceiling situation. Yeah. Yes. I've learned a lot about we've had a lot of these debt ceiling situations over the years, and there's a tremendous amount, but there are some new things that have happened and some new things that I've heard about just recently in this one. First of all, interestingly enough, they have a thing called a discharge discharge petition, where actually in the negotiations that were going around in the GOP party to get McCarthy placed into the speakership role, it was basically requested that they be able to put a bill onto the floor without his approval. And they need majority to sign on to that, to put it on the floor. Well, the Democrats turned around and decided to use that, and they put a bill into committee. The bill has to be into committee for 30 days. It's already happened. And they're going to then introduce that and amend that to be a debt ceiling increase. And they literally put a piece of paper out on the secretary's desk. 218 House representatives have to go and sign that. And so if you assume that every Democrat would sign it, then you need 5 more Republicans to sign it. Now, there were 4 Republicans who did not vote for the GOP bill. Again, I think by estimation, there's like 25 to 28 Republicans that are in pretty heavily blue areas, purple areas, areas that Biden won. And so they're concerned about, these types of things. And I suspect that in the end, they'll find 5 to do that. Unfortunately, I suspect that won't happen until there's more chaos that happens to kind of drive that need forward. But once they get those signatures, then they can put this bill on the floor. Theoretically, they've already got enough signatures to get it on the floor, which is a majority, and then they could vote for it. I wouldn't be surprised if that does happen, if it's not more like 20 Republicans that step across instead of 5, just because it'll mitigate the kind of the blame across the board.
Backlash.
Yeah, maybe it's better to come across as a bit of a block. I do think they'd be able to go back to their blue areas or what have you and say, hey, we stepped across and, for the betterment of the country or what have you. Right? There's some political reasons. They're up for election every 2 years. So it's a much different scenario than it is for the senators every 6 years. So that's interesting. The White House is also apparently contemplating declaring the debt ceiling unconstitutional.
Yeah, using the 14th Amendment.
Yeah, and so that's not been, I haven't seen much on that before. I think that's kind of interesting. The 14th Amendment basically, and I'm paraphrasing dramatically, basically says that Congress doesn't have the authority to authorize the money that's being spent. So, there's a whole bunch of other kind of gimmicky things that have been talked about, like printing a $1 trillion coin, all of these things. So I suspect that we don't default, but I also suspect that we get close enough to create some havoc in the market. It would be really nice to see that not happen, and it just gets passed and people, if I'm in the House, honestly, there's other things you got to be working on besides this, right? I mean, you're not going to get what you want, in my opinion, out of this, and so why not just, make some noise and then move on and work on something you might be able to get done. But I don't know if that's the environment that we're in right now.
Yeah, because was 2011 with the Tea Party that kind of did a very similar kind of hold the government hostage in a sense.
Yeah. So market dropped 17%. That was the worst one. Last time it happened, it was down 5%. But this is more like the Tea Party arena than the last one. But and in 2011, actually, the U.S. debt got downgraded. And so the U.S. had to pay more for interest on their bonds that they have to issue because we're running a deficit. Ended up costing $18 billion was what I read in extra interest cost because of that. So these are all things that end up happening if we get too far down the road. So I hope we do. And Janet Yellen's comment about June 1st. I don't know if that's true per se. I'll assume it is, or if it's just a tactic to try to get Congress to move faster. Because if it's August 31st, not a bad idea to tell them it's June 1st.
They're not going to move until they actually have to.
Yeah, so let's move the deadline up a little bit in front of Armageddon. I don't see that as a bad strategy. I wouldn't blame her or the Treasury for doing that, but. It's hard to tell what's going to happen. And they probably don't know for sure because it does have to do with revenues and expenses. And, the revenues are sometimes really inconsistent because it's tax revenues coming in. Yeah. So, but very, very good question. Very topical right now.
Can you summarize the Fed's interest hike and Powell's comments after the hike?
Yeah, so the Federal Reserve met on Tuesday and Wednesday of this week, and then they announced, their rate increase, and they have a statement. And the biggest thing that was in that statement that was important was that they went from saying we anticipate future rate increases to we're going to be analyzing it on a meeting by meeting basis. And Powell pointed that out a couple times. So that's very important. I know it seems kind of minor, but it isn't in the world of the Federal Reserve. Believe me, every word is parsed in these statements. And then he does a question and answer session. He said some things I thought were interesting. Number one, he felt the banking system was in good shape now that we've taken care of, the situations that had happened up to that point. It has transpired that we've had other problems since that comment, so we'll see how that works. I hope he's right. They have views of the bank. That's their job, is to regulate the banking system. However, what they can't control is the fear and the fact that money can move with the push of a button so rapidly. and so things could transpire. And on Wednesday, the banking system could look good. On Thursday, it could look not so good, right? And that's the reality of today. So the other thing that he said that was significant, in my opinion, was that the market is anticipating a rate decrease by the end of the year, fairly significant, someplace between 0.5% to 1%, depending on what part of the market you look at. And he said that he did not anticipate having any rate decreases throughout the rest of this year, that they would be holding it at this level. Now, the previous meeting, they came out with a statement of economic projections. They only do that 4 times a year. Mm-hmm. And in that, the consensus estimate was that we would get to 5 to 5.25, which is where we're at right now, and we would stay there for the rest of the year. So he was just reiterating what the consensus statement was. However, the market is not seeing that. The market is seeing weakness that's coming through that's going to require the Federal Reserve to lower rates to kind of deal with that weakness. And it is especially being exaggerated by the banking situation. If you look at the futures market, it is directly related to what's happening in these regional banks. And yesterday, when those banks had trouble, it moved all the way back to expecting a rate decrease by July, instead of not November, December, July, because things are going to deteriorate here. Was what the market is thinking. Now again, government steps in, changes that story, backstops that. You got to be careful with what's going to happen there. Just respond to price, and I think that's good. But that's probably a decent summary of what I saw, watching that conference.
So what happens to Social Security if the government defaults?
Yeah, okay, so here's something to keep in mind, that the government defaults doesn't mean they don't have revenue coming in, right? It just means that they don't have the ability to go borrow more money. So let's say that your expenses are $100 and you have revenue coming in every month that's $75. You're short $25, right? That's your deficit. So you go borrow that $25. That's in a nutshell, that's exactly how our government works and how they finance. So every month I got 25 and I got 50, 75, 100, so I'm accumulating debt just like we are. And the Congress has to be able to allow that debt ceiling to increase. And if they don't, theoretically, depending on what else might happen, but theoretically, they can't get any more. So, but we still have the $75 coming in.
Yep.
So now we're going to have to decide, what are we not going to pay with that other 25 that we would have borrowed that we can no longer do. And so that's where it's going to get really interesting. What doesn't get paid? So there's a couple key things that are out there. Number one is the existing debt that's there has interest payments. If you want to continue to issue new debt, and we're considered one of the greatest places to borrow money from in the world, in signs of stress, people buy U.S. treasuries like mad, and so you really want to make sure you're paying that, in my opinion. And then Social Security is another, I think, really big one. But there's a lot of big ones. What do you do with Medicare? Where do you cut?
Yeah,
right?
You gotta pay people's salaries, who gets paid,
federal pension, right? So I would suspect that Social Security gets covered in that arena, but that's a conversation that's going to be really interesting to.
It's going to be someone's going to get burned in political capital if it goes down to the line.
They do, there's military spending, there's but the big money goes out to entitlements, medical, right? Social Security is one of those entitlements, and so that it would be hard. You'd be hard pressed to not have some impact on something somewhere. Social Security might be excluded, but it is such a big piece.
Yeah, 70 million people receive Social Security. Wow. So when you think about it, some people, that's all they get. And so if you disrupt that, they're just going into poverty, and they're.
Yeah, right. It's a situation that I don't think is going to happen because of that. I think that they'll do some crazy other scenario. I know Janet Yellen has said that she doesn't think they'd ever print a $1 trillion coin, but honestly, because it's kind of a gimmicky thing, which would have some ramifications for our credit rating or what have you, I'd imagine. But if it's a choice between that or not paying Social Security payments or something, I think that there's some extreme measures that they might employ here. So hopefully we don't get there. But it is making people nervous. I'm very, very happy that we have our signal system for this environment. We're actually picking up new business from people that are worried about the debt ceiling, and they like the fact that we will do something to kind of protect, the asset base. When we get to our red light signals, we'll be mostly in T-bills, kind of waiting for this to play out and see how this goes as far as that goes. So, yeah, it's a time where, and I've done this before. We've gotten defensive in the last two debt ceiling arguments, only because just the thought process of what would happen is too scary to sit there and go through. And it only dropped 10% 2 times ago and 5% last time. Probably should have just hung in there, but the risk is higher than almost anything else I can think of that's happening. The banking situation is a really big risk, but as long as we can print money, we can probably, take care of that, bail them out and backstop depositors. But when we can't print money or borrow more money, that's one of the basics. I think if that goes away, so I think they'll do something either reasonable-ish in today's world, or extreme to make sure that it doesn't happen. But
yeah, because in 1979, technically the U.S. defaulted. The Treasury will never say it defaulted, but it cost the T-bills went up in 0.6% interest rate across the T-bills.
Yeah.
So like any kind of default or kind of issue, it just drives up the cost so much more.
Yeah. I believe we're the only country in the world that has this debt ceiling thing. It's really it's too bad. It's something that's become a political weapon, and if we could get rid of it, it would be a really good day in my book. But we're still here. We got to deal with it. All right. So, do we have time for one more question? We have a short one.
Why do bonds have a lower return than stocks in the long term?
Why do bonds have a lower return than stocks? I think bonds average 5.5% if you look at kind of the whole market or something, and the stock market average is 11, basically double. And the reason has to do with the risk that you're taking. So with a bond, it's essentially a contract with somebody, a company, government, whatever. And so par value is usually $1,000 on a bond. And so you would give that government or company or whatever it is $1,000, and at the end you get your $1,000 back.
Yeah.
So that's a huge difference than stock. I give $1,000 to a company or buy $1,000 worth of their stock. No guarantees I'm getting anything back whatsoever. It could go to zero. Now, let's say that company goes out of business. Bondholders still have a right to settlement through,
they have priority over stockholders,
right? And so stockholders, common stock, I think, is at the very end of the line.
Basically, you're out of luck.
Yeah, I haven't seen a lot of payments of anything going to common stockholders in a liquidation sale. Yet bondholders do generally get paid some. So in the overall concept of finance, the more risk you take, the more reward you would require to take that risk. If it's pretty simple. If I could make 5.5 in the stock market and 5.5 in the bond market, well, why would you ever do the stock market?
Yeah.
Right. And so you're going to do the bond market, and it is one of the reasons why when rates come up, the stock market tends to struggle a little bit more. Because again, if I can get a 10% CD, why would I do 11% stock market?
Yeah. Why take on that risk?
Yeah, exactly. So that's why it's just a matter of what's happening in the risk arena as far as that goes. So, good question. All right, good. I want to thank everybody for coming today. Thank you for putting up with our couple of weeks off here. Look forward to being able to see you again next week, and we will see you then, and hopefully be able to help you. Of course, you can send in your questions now for next week if you'd like. Well, it's topical. We'd be happy to answer those. You can subscribe to our channel, hit the bell button to get new, notification of new things. And of course, you can book an appointment with us if you'd like to meet with Ethan and I to talk about your specific issues and such too. So thank you very much for joining us today, and I look forward to seeing you again.